All right, everyone. The Metro Detroit market is shifting yet again, and this week's numbers tell a very real story. It's not doom, it's not hype. It's just what's actually happening so that you can make smart and educated decisions. And yes, the industry is definitely buzzing about a possible 50-year mortgage, which could instantly change affordability, demand, and buyer behavior the moment that it's approved, which could be as early as January. Eric, the rates dipped, they shot back up. I think everyone's confused. Can you break down what's really happening on the mortgage side and also touch on that 50-year mortgage? Because I know that's what everyone wants to hear about.
Yeah, 100%. So there's really two big stories in mortgage right now. One is the government is reopened. Feels so good for all those people that have been laid off and furloughed. They're back to work before the holidays and hopefully getting full paid compensation. So that's great news for everybody. What how that affects mortgage rates is really what mortgage rates move on is based on inflation and unemployment rate, right? So jobs that are being created in the economy and inflation coming out. Unfortunately, the people that track that are the government, right? So there has been no data in about 45 days coming out with these things. So rates really don't know what to do because they don't have the information to act off of. So that's going to be huge. We should start getting jobs numbers as early as next week. And it'll give those investors who are setting those bond rates and terms some information to act on. So hopefully, and I can't believe it would go anything but down as we just coming off a government shutdown, which definitely hurt the economy over the last month and a half. Two is that 50-year mortgage that Trump is proposing. Now, most of the news that you're going to hear, most of the things coming out is how much more you're going to pay over a 50-year term than a 30-year term. And it's 100% correct. But what people are kind of failing to miss is not staying in a 50 or more. I mean, if you're buying a house at 40, you're really planning on staying in it until you're 90. And I don't mean staying in the house, but I mean staying in that mortgage. The average American stays in a mortgage 4 years, and then they're likely to refi or move. So that's the average span of a life of a mortgage today. So take the example of a first time home buyer that's trying to get into a $400,000 house. And if you go to try and make that payment right now, you can't maybe pallet the 30-year mortgage payment, right? It's just too high. It's not affordable. But you're paying rent somewhere maybe $300 or $400 below where that payment would be on a 30-year mortgage. Enter the 50-year term. The 50-year term gets you that payment down to right close to where you're renting now. So is it a good long-term strategy? Absolutely not. Is it a good short-term strategy? And we want to look at that. So if I buy that house on the 50-year arm today, let's just say the payment's $2,000, just for an example, right? And you're paying rent at $2,000. And you get into that mortgage. Now let's think about 5 years down the road. For the next 5 years, you have a $2,000 mortgage payment. Is your rent going to stay the same over the next 5 years? No, it's probably going to go up by 5%, right? This is inflation. This is what happens. So now over that 5-year term, instead of having a fixed payment, you have a payment that's going to continue to increase on you. Okay. So you're going to end up paying more over the 5 years renting than in this 50-year mortgage. The other thing that people are not taking into context is inflation affects housing. We know this, right? Housing goes up in value roughly 4% a year. So if that $400,000 house that you want to buy is now going to be in 5 years roughly $485,000. So over the next 5 years, you're not only going to overpay in rent, but you're also going to have to buy the same house and you're going to pay $85,000 more for that house. So even if rates come down over the next 5 years, chances are your payment in 5 years is going to be similar to what it would be if you bought the house today because the value of the house has appreciated so much. So if you're getting to that 50-year term now, one, you're going to gain $85,000 in equity in the house, and your payment's not going to go up. It's a fixed payment. Take that out over the life of the loan. And this is something Brian Decker and some other kind of industry experts have said. Look, take the savings between the two, put it in an S&P index for the next 50 years. See how much growth that generates because S&P has averaged 10% year over year. So that money would actually be gaining you. That's how you can build wealth using inflation to your advantage. And this is what investors do. This is what the big companies do when they look at investing and buying homes. They know that even though the rate is a little higher and they're going to pay interest over time, that money they can leverage and invest in other opportunities is going to gain them more money than what the additional savings is going to give them over the term of the mortgage. What you're going to end up doing is you're going to pay that mortgage off early. Is what's going to happen, and you're going to have a house far cheaper than what you're going to be able to buy it for in 5 to 10 years if you're just saving money. So that's really what's getting missed on this is it is a tool. It's not a great long-term solution. It is a tool to get people into houses now and to fight this affordability issue we have. And then again, make sure you're working with someone that's working on your longer term strategy to get you out of that 50-year potentially and get you into something less costly in interest over the life of the loan. But at least at that point, you're a homeowner and you're not a renter and you're not running into this same issue in 5 years that you're running into today.
Yeah, I'm totally with you. When it first came out or when I first heard about the 50-year mortgage, I was thinking to myself, man, the banks are the only ones that really win in this scenario. But then I started to dive a little bit deeper, and if you look at it as just a stepping stone, then it makes sense, right? Because I also saw a headline just last week that first-time home buyers are at the lowest that they've ever been in history. That meaning the number of first-time home buyers in the market today is the lowest it's ever been in history ever. And
And
that's
if you
that's
look
an
at that,
affordability issue.
it is. It's an affordability issue. And what does that mean? It means that existing homeowners who have been making the equity on their house because they own it now have cash to reinvest into a larger house, where renters or first time homebuyers have no equity roll over and buy the next house with. So they're continually hitting their head against affordability issues. And so you can either make the appreciation for your landlord or you can make the appreciation for yourself. It's going to be a similar payment. And yeah, you're not going to get, you're not paying a large portion of that payment. Most of it's going to interest, right? Almost all of it's going to interest. But what you're getting is you're getting an asset that's appreciating at the same price as you can rent, and your landlord's asset would appreciate. That's why you have landlords. They know how this works and it makes them money.
Yeah, I mean, it really works well for an investor, right? So let's say they save $300 a month. Well, most investors are just trying to buy properties where they can make $300 a month per door that they own. So this really is a great product for an investor, in my opinion. It allows them to cash flow the properties that they wouldn't have otherwise been able to cash flow. Now that's going to create more rental properties, or it should, if everything goes how I think it'll go. The other thing too is, you don't get benefits of the tax write-off, right? If you're renting. So there's other benefits. And there's also, tricks. So let's say you get a bump in pay at work. Well, now you start, throwing the lender an extra 300 a month towards principal, or an extra payment per year towards principal, and it starts really to knock it down, right? So you're, again, if you're using it as a stepping stone, then I think it's a great tool. And if you're going to stay in it and pay all the interest over the next 50 years, I think it's a horribly bad play, but I don't think that's the point here, right?
Yeah, 100%. And like you said, the people that are going to take advantage of this that have done the math are the investors and they're chomping at the bit. And it's just, again, a lot of it is the mainstream media just telling you about how awful this is. And strategically, longer term, use inflation to your advantage. The inflation means you're going to make more money. The cost of everything is going to go up over the next 50 years, but you can stay at that same payment. It's how you and I at our age are looking at our parents going, holy crap, your mortgage payment's $250. Yeah, because they bought the house 25 years ago and the cost of that house was a quarter of what it is today. That's just going to continue. So you can either lock in at today's rates and get yourself a fixed payment that you can refi and you can potentially bring down, or you can pay down over time. You can do a lot of things with it, but you have the asset. Now you own it. You're not paying for someone else's asset. So I think eventually people are going to catch on to this, right now, I think that's been the hard sell is in the media, on Reddit, on social media, everyone's saying this is a terrible idea. But I think if you kind of look at the people proposing it, they're the guys that made money in real estate. They're saying this is tremendous. This is huge. You're going to let me pay off this over 50 years at a fixed payment, and I know that value is going to keep going up. So, yeah, in my head, it's uh, it's not going to fit for everyone. And if you can afford the 30-year term, you 100% want to do it. But it is an avenue for people to become homeowners and to start owning the largest asset they're probably ever going to own in their life.
100%. I mean, there is such a thing as good debt, and it all goes back to the good debt, right?
Yep.
I'd rather do this play than, get into an $800 a month lease payment on a vehicle that just depreciates.
I mean, debt is not, shouldn't be a way of life. It should be a tool.
Yeah,
Debt is the
exactly.
way wealthy see this, debt is a tool to build wealth. And homeowners need to start thinking about this in those terms. Thinking about it, rich aren't rich because they're smarter than everybody. Rich are rich because they have the information,
Leverage.
leverage and information on knowing how to do these things.
Yeah, exactly. Well, let's talk about the local market, Metro Detroit. New listings, they're double what they were earlier this year. To give you some context, last month we had 1,000 new listings hit the market. In February, there was 8,000 new listings that hit the market. So it's nearly double the new supply hitting the market in just less than a year, maybe a 6-month stretch. Homes for sale, it's the biggest spike in the last 5 years. Today we have 25,704 for sale. It's the highest level of inventory we've seen since September of 2020. What that means to you is that buyers have a choice today. The sellers are feeling the pressure and buyers have opportunity. The month supply of inventory, that line is shooting up. February, it was 1.9 months supply of inventory. Today, it's 3.1. So that's a massive jump in 1 year, and it's moving us more towards a balanced market. We've got more inventory, fewer buyers, and what that equals is a slower pace and more negotiation. We also saw our pending offers, our pending sales, our accepted offers, they are declining. In June, we had 11,000 accepted offers. Today, or last month, I should say, we had 9,500. So it's a downward trend. What it means is fewer buyers are writing offers. Fewer buyers are writing offers. And closed sales are the same exact story. July had 11,000 closings. Last month, we had about 10,000. So there are deals that are still closing. It's just less. So we're seeing this downward on pending and closed, which means buyer demand, and an upward on month supply of inventory and the number of homes for sale. So basically crisscross lines. Now, if we look at the last 7 days in the local market, we had 3,700 new listings, 1,800 went pending. We had almost 2,200 price reductions. So we had about 400 more price reductions than we did accepted offers. 2,700 actually closed, they sold. So again, price decreases outnumber pendings, and that is the current climate for the Metro Detroit market. I will say the Midwest is holding tighter than any other region in the nation. You have markets, Florida market, Arizona market, California market. They are getting crushed, and the Midwest is holding tight more than most other cities in the nation. So we feel blessed about that. But what all of this information ultimately means, it means that buyers, you have more leverage than you've had in many years, and sellers, you have to price correctly from day one. Homes that nail the pricing and the presentation, they're the ones that are still selling in week one. The homes that miss the mark on presentation and pricing, they end up getting cut 2 to 3 times, 2 to 3 price reductions. So ultimately, I don't want this to be like a depressing story. The market's definitely not crashing. It's normalizing, it's balancing. after an extreme 3-year run. And every week brings a little turbulence because these rates keep bouncing. And that's why we're not getting, the buyer demand is down because these rates keep bouncing all over the place. I think consumer confidence is down, but hopefully, like Eric said in the beginning, the end of the government shutdown might help this situation. We need buyer demand right now. If you're a seller, we need more buyer demand in the market. Eric, you have any closing thoughts?
No, I don't. I think you hit it on the nail. It's 100% what people there's still homes to be sold. People are still buying houses, but you have to hit the market with the right strategy and the right pricing. When you do, we're still seeing multiple offers on stuff that hits the market immediately. But those are the ones that are selling. The ones that are sitting, buyers are waiting to say what's wrong with it, or hey, I don't want something that's been picked over. So it's difficult. It's difficult if you've been in the market, but yeah, I think you hit the nail on the head there, Ben.
Awesome. Thanks for watching, everybody. We'll see you in 2 weeks.